the most successful investor of all time, Warren Buffett, currently has a fortune of $93 billion. Believe it or not, Buffett, like most of us, wasn't born rich. He started as a small boy delivering newspapers and selling Coca-Cola cans. In this video, Warren Buffett reveals his 3 simple rules for beginners to successfully start investing in stocks. You'll also learn how to avoid mistakes that can ruin you. At the same time, Warren Buffett asks you a personal question in the video that you must answer before buying your first stock. Enjoy the video. I started investing when I was 11 years old. Before that, I was rather dawdling around when I was 7, 8, 9. So I, unfortunately, didn't really start before I was 11. I bought my first stock when I was 11 years old. Then I experimented with a whole series of things, timing stocks, right? Analyzing stock charts and all these crazy things. It was a lot of fun. Although I was unsuccessful, it was fun. I did these experiments until I was 19. I read all the books on investing in our public library. I devoured the books. It was fascinating to me, but I had no firm rules, no plan on how to invest. So I searched for an answer and hoped that small changes on my chart would tell me where the stock would go in the future. It was crazy, but everyone else was doing it, so I thought I'd do it too. Later I realized, even if you turn the stock chart upside down, it won't help you. Then everything changed in 1949 when I was 19. I read Benjamin Graham's book, The Intelligent Investor. Until then, I had never heard of him, and there are really only 2 chapters in this book that were my key to success. These were the 2 chapters that laid the foundation for everything that would follow for me in investing. There are 3 basic rules in these 2 chapters. They are so fundamental and so simple, it's hard to believe they can be that important. The first rule is, a stock is a share of a business. You can't think of a stock differently than as part of a business. You evaluate a business and divide the business value by the number of shares outstanding, and then you get the price for a share. But what you have to think about is what kind of business you are getting into. What is the economic situation? What is the competition like? How does the management behave? All these things have to do with the business and not with a ticker symbol. When I was 11 or 12, I knew every ticker symbol for every company listed on the New York Stock Exchange. The problem was that it brought me nothing because I knew nothing about the companies. I knew the ticker symbol was shorthand for US Steel and T was the company and so on, but these were unnecessary things. I knew nothing. I didn't know what was behind the abbreviations and the companies. So I had to get used to viewing these abbreviations and names in the newspaper as businesses. I had to know how to evaluate a company. What really counts when buying a stock? The second rule in the book is, Graham gives you a wonderful guide on how to react as an investor to market fluctuations. In Chapter 8, he talks about his mythical Mr. Market, and nothing better has been written to this day regarding an investor's behavior during stock price fluctuations. Most people react wrongly to changes in stock prices. I mean, they feel good when prices go up and bad when they go down. So they think the stock market is there to show them the way. And Mr. Market is this guy you have when investing, and he is an incredibly accommodating fellow. This guy comes to you every day and tells you how much he would pay for your business shares, or tells you from which stock you can buy more at the same price. In private companies, no one will do that. If you and I owned a gas station together and I tell you every day, I want you to make me an offer for half of the station, and then I could either buy your half or sell you my half, both at the same price. And if you did that every day, then you would have huge disadvantages because fees are incurred each time. Above all, you would have disadvantages if you were Mr. Market yourself, because our friend Mr. Market kindly gives you a price for your stock every day. More accurately, the prices fluctuate daily, and you get one price in the morning and another in the afternoon, but he gives you a price at which you can either buy or sell. And the wonderful thing about him is, the guy is a drunkard and manic depressive. I mean, he is so unreliable you can't imagine. He wanders around all day and keeps quoting you totally crazy prices. But now comes the kicker. You don't have to pay him a second of attention unless it is advantageous for you to do so, if that's once a year or once every 5 years. And if it's only one stock out of 3,000 different ones, all you have to do is just sit there doing nothing. You have no moral obligation to this guy. I mean, he quotes you these prices, you didn't ask him, but he does it anyway. All you have to do is pick a day when he is particularly depressed or has overdone it and is drunk. Mr. Market will be all of that, and you capitalize on his benders. And the peculiar thing about stocks is, if you look at the highs and lows of prices of all companies for the last year, then you will see case by case that the high is twice the low, and that is for reputable large companies doing well, paying their people, selling goods, and so on. If you look at farmland, there is never in life the opportunity that you get the farmland for half the price within a year, so the value rises from 10 to 20, and conversely falls from 20 to 10. Maybe the value changes from 10 to 11 or from 11 to 10. And if you look at residential real estate, they are likely not going to go up or down 10% in a year. But here in the stock market, you get the best companies in the world, and over the year, you are quoted prices that are completely irrationally swinging up and down. You don't have to play unless you want to strike. That is the most important thing. And what Ben Graham tells us, the stock market is not there to show you the way and give you a guide. The market is there to be used to your advantage if you want to. That is one of the most important things to remember with stocks, and many find it difficult because they put all their emotions into it. The stock doesn't know you own it, it has no feelings for you. I mean, you have all these emotions with stocks, but they are just portions of a business. But exactly that is not what you are taught on Wall Street and in magazines. All you hear are price targets, but you don't see anyone writing about what the features of the business are, what the advantages compared to the competition are, and whether the business model will work the next 20 years. What should the company be worth? What is the fair price? So forget at what price they are traded on the stock exchange. In fact, one of the things I like to do when I'm looking at potential investments, I look at the businesses without knowing the price, because as soon as you see the price, it would automatically influence you. The third rule in Graham's book is the margin of safety. If you come to a bridge that has a sign saying maximum weight 10,000 kilos and you drive a 9,800 kilo truck, then you better keep going and find another bridge. I mean, nobody knows how much the bridge will actually hold, especially if the sign is already 34 years old. So you make sure you never take that much risk about the bridge withstanding or breaking down. You make sure you have an extremely sturdy bridge. For the stock market, that means you wait until a stock practically screams at you to buy it because its price is so cheap. Based on these three principles, you can build all the other rules for your investments. These three rules are the foundation, and if you internalize that, you will find that nothing else has helped as much. All three rules are important, and if you take away one pillar, an entire building collapses. I would say the most important thing over a long period, and if you are working with a lot of money, is you have to understand the business you are investing in. Let's say for this example, you get $1 million and you have a week to find 3 companies in your region, wherever you live, to invest in private businesses that are not publicly traded. You have a week or you have to return your money. What would you do in this 1 week? You'd probably look at all the businesses in your area. Some you will know well, some less well. Some you only know through their good reputation. Some you know the managers, some you don't. You know the competitive situation of the companies. What are you thinking about during those 7 days? How will you ultimately filter these companies out to choose the top 3 for you? Important is, you can't sell them once you have bought them. You will own them your entire life. For this reason, you will look for companies that have a lasting competitive advantage. You don't want to buy a Burger King franchise just because there are no other fast food restaurants within 15 kilometers, because sooner or later McDonald's will also be there. What is important is that even when other competitors arise, the company nonetheless remains in control because it has a lasting competitive advantage. For that, you need a company that has a moat. Capitalism, by definition, is a system where everyone with a business, that is with their castle, is under attack. That is the nature of it. You open a successful restaurant in your city, and some guy copies your menu, poaches your cook, offers a cheaper price, or provides more parking spaces. In capitalism, it is common that your castle is attacked, and when that happens, you want a castle with a large moat around it. And there are many ways how a moat comes about, for example through registered patents or through a unique location at certain sites. If you have something that has stuck with people like Coca-Cola, I mean almost 8 billion people in the world know Coca-Cola, and most associate it with something positive. Very few of them know the no-name cola from a supermarket, but everyone knows Coca-Cola. And even if that no-name cola spent $1 billion on advertising, almost no one would know it because Coca-Cola wants to be associated with positive emotions among people. That's why you see Coca-Cola everywhere people experience something positive. At festivals, in Disneyland, in theaters and cinemas, at the Super Bowl, Coca-Cola wants you to always drink it when you're happy at the same time. And if they manage that, then they will sell many Coca-Cola bottles. And that's precisely a lasting and almost an unfair competitive advantage. What you want is for your company to be run by honest and capable people. You don't want a swindler as CEO. And the best companies you can buy are those where it doesn't matter who runs them. Peter Lynch says, buy a company that's so good that even an idiot can run it because sooner or later one will. And that's exactly what I was asked by a student a few days ago. What happens if you become crazy and no longer mentally able to conduct workshops? And I say, Berkshire is so good that I can become crazy. Maybe I already am. These are the companies you should own. But you want a management team that is honest and capable, and you want a price that is fair. And that's exactly what you look for in your region. So you have a week to pick 3 companies, and right away you will realize which companies are completely off the table. If someone told me that my life depends on me picking the 10 best stocks from the 30 stock Dow Jones, I would spend all my time eliminating the worst stocks. I would therefore sort out companies, and that is an easier way to tackle this problem than picking the top 10 companies from the 30. And when you think about your region in which you live, then surely there are industries where you would not trust your assessment. Suppose you say, car dealerships are too difficult because there will always be great competition in this industry. Then the question is, which car makers will sell more cars in 5 years than today? And whether your dealer is on the right horse with the car brand, and above all, if you're still allowed to sell big internal combustion cars, etc. So you tell yourself, I give up on car dealerships and look for companies from other industries. This approach is the same one you should bring to the stock market. There are 8,000 stocks worldwide that are well tradable, and each one has a price. Tomorrow the price will already be different. Remember, you don't have to strike, you can wait. If you make only 5 good investment decisions in your whole life, then you will be very, very rich. Sometimes I tell students they'd be better off if they got a punch card. Once they're out of school and that punch card has only 20 slots, one for each investment decision. Because then they'd think for themselves instead of following stock tips from other people at cocktail parties. You really have to think about every single one of the 20 slots. 20 slots are all the decisions you get, and 20 is more than enough. Here in the top right, you'll find my portfolio that I use for long-term investments in stocks, and in the top left is a video that might be interesting for you. Thank you for watching. See you in the next video.